Why should you invest in stocks? Do you need money for your child's education? Do you want to save for retirement? Do you wish to grow your wealth and beat inflation? Can investing in fixed deposits help you achieve your financial goals? Let's take a look. Fixed deposits yield a 7% return, whereas investing in stocks yields a minimum of 20% return. What does this mean? A lump sum of Rs 1 lakh invested in fixed deposits for 25 years would grow to only Rs 5 lakhs, but if invested in stocks can grow massively to Rs 1 crore. Do you know, if you had invested Rs 10,000 in Infosys in the 1990s, today, your investment would be worth over Rs 11 crore. What is this called? Yes, the power of compounding. But what are the rules of compounding? The key principles of compounding are: invest regularly and consistently. Be patient, as compounding needs time. Invest in good quality assets. And start early. Let time work in your favor. Just look at the power of compounding. Investing Rs 4,000 monthly and regularly through a systematic investment plan for 30 years at 11% can help you accumulate Rs 1 crore. Alternatively, investing Rs 30,000 monthly can achieve the same goal in just 14 years. But is investing in stocks safe? Will I lose all my money investing in stocks? Is the stock market too volatile? And can stock market downturns wipe out my investments? Come, let's explore answers to these questions and understand how it works. Let's look at this example. Alex and Sarah launched a new tech startup with a brilliant idea for a gadget, but needed funding to expand their business. That's when they decided to take their company public by listing it on the stock exchange. To do this, they prepared financial reports, met with regulators, and launched an initial public offering. The company's stock was listed on the stock exchange, and people could buy and sell the company's shares, making them part owners. So, a stock is a share of company's ownership, and if the company does well, your investment will grow. The stock prices go up and down, based on demand, supply, company performance, economic conditions, and market sentiment. Finally, to conclude, it is important to select quality stocks, which are financially and fundamentally strong, which are fairly valued, and have a stable management. As a beginner, start by investing in mutual funds, index funds or ETFs until you learn how to pick stocks. Invest for at least 3 to 5 years for best returns. Short-term dips are buying opportunities for long-term gains. If you found this video helpful, do like, subscribe, and share. Happy investing!